wealth versus income. Now, why am I looking at this? Well, primarily we've got a budget coming up at the end of November, and the Labour Chancellor has said that she needs more money. She does it every year. I think 40 billion is the black hole this time, probably caused by previous incumbents, but there we go. So she's got to fill it, and she's going to fill it through, well, she's not going to stop spending, so she's going to tax. So that's what we're doing. But they've talked about taxing wealth as opposed to taxing income. And there's a big difference. And I want to clear that up with you today, because you go over here, you've got income, which is money that you earn, obviously. And over here, we've got wealth, which is predominantly assets, things that you own, you know, like shares, property, that sort of thing. Assets, gold, silver, all those things. Now, the phrase, of course, goes that what you earn versus what you own. So that's a nice sort of phrase. So what you earn, there you go, versus what you own is the phrase to use here, which distinguishes the two. So let's just take a look at some of these briefly, just to remind you. Income, well, there's all sorts of income, isn't there? There's earnings from salary, there's profit from self-employment. That's all income, isn't it? That's most people's income, isn't it? You've got dividends from shares. You've got interest, of course, from savings. That's all income as well. You might have rent from property, of course. That's income. Can't disguise that one. The thing about income, though, is it's all very progressive. You've got high net worth rates and percentages. It's very progressive. The more you earn, the more you pay, which is right. Stiff shoulders, all those sort of things. You've got bands. Limiting how much lower income people pay. You've got allowances and all sorts of things. And the kind of taxes, well, national insurance comes into its own, of course. Income tax is key. These are the main ones, aren't they? Don't forget VAT, not on earnings, but people earn and they spend it. So I suppose it could be construed as such. And on the corporation side, of course, you've got corporation tax, which is company earnings. So as you can see, income is quite easy to spot, easy to tax. You just put income tax up, national insurance up. But wealth's a different thing altogether. If you've got wealth, so you might have shares, for example, is a big one. You might have property. You might have other kind of assets as well. Gold, physical assets, pension pots arguably come into that as well. If you're saving for a pension, all those things construe as wealth. And they're looking to tax that more in the budget. So what are they going to do differently? Well, first of all, let's see what sort of taxes we've got and what sort of property and assets. Let's take property. That's the first one for you. Let's just put our property in there. Your first property or second property, it doesn't matter. That's taxed massively at the moment. You've got stamp duty, land tax, of course, on buying property. That's been around for a while. You've got capital gains tax, which you pay on second properties or holiday homes, up to a large amount as well. And of course, you've got inheritance tax when you pass this on to people, less various exemptions and nil rate bans. What do I think about doing in the budget? Well, the other tax, which you mustn't forget, is council tax. Council tax is based upon your property ownership value. They're looking at maybe increasing that for high properties, high value properties. They're looking to increase the council tax. They're doing it for second homes all over the UK at the moment. And that's caused a lot of housing bubbles around the coastline to explode, which is not good if you're selling a property. But they're looking to do some kind of wealth tax. Let's talk about maybe just apply 1% of your value of your property as an annual tax. That's brand new, isn't it? So that maybe homes over 500,000 or homes over 1 million. And in London and the South East, that's quite a few of them. So that's been talked about quite a bit as well. What else have they been talking about doing in the budget maybe? Well, pension pots is another kind of, let's just put in there, pension pots are another kind of wealth, aren't they? You've built up your savings, you've got it in some kind of asset-backed investment savings pot, and you're going to have that when you retire. Now, the pension commencement lump sum has had a lot of changes, of course, recently. They may be limiting that even further. So that's not good news for lots of people that got big pots. Essentially, it's 25% of your pot, subject to a maximum 260 something thousand. But they might actually reduce that cap even more, which ain't very good, is it, for a lot of people? Inheritance tax was brought in the budget last year from effect of 2027. Your pension pot now forms part of your estate. If you die, it gets passed over to your next of kin, will become liable to inheritance tax, which isn't particularly good if you've got a large legacy to pass on. Of course it's not. What else are they looking to do? Let's have a look at what other wealth taxes we've got as well. Well, the other one, of course, is inheritance tax. When you have a wealth, it passes on to your next of kin on death, and there's inheritance tax payable. We've known that for many years. They might even tinker with the 7-year pet rule, where you have a potentially exempt transfer, gifts and things. They might make that 10 years. That will certainly bring in a bit more money as well. They might get rid of the residence nil rate band. So at the moment, if you've got your own property and it passes on to your kids or grandchildren, less a certain amount, I think it's 2 million your estate is worth, that can give you an extra nil rate band to add on to your other nil rate band, giving you $500,000 of nil rate band for a single person. They might get rid of that. Again, that will produce more money as well. Other things they're looking to do, now obviously a big one up here is capital gains tax. Let's put that in there for you. CGT, capital gains tax. Now they increased it last autumn. They might put that up in some way or form. There's talk that they might make it the same as income tax. There you go. So income tax, of course, has bands, progressive taxation up to 45% for high earners with allowances and stuff. They might make it very similar to that, and that will increase the amount of money they bring in. The other one, which I'm certain they're going to do, and that's going to affect a lot of your clients, actually, mortgage advisors or financial advisors, is shares. Let's put that in there for you. Now shares, let's put shares in there, or unit trust or collectives, whatever you've got your money invested in, outside of a pension fund here, are taxable, unless it's in an ISA, of course. But if you own a share, it pays a dividend, which is pretty much its interest, really, isn't it? The profit of the company is made each year and they pay it out in the form of dividends, and they're taxed at different rates to income tax, quite low rates as well for basic rate taxpayers. Now, okay, if you own shares, that's just a bad thing to do, but a lot of people run limited companies in their own name and pay themselves dividends as well as a small salary. We call those people owner directors, don't we? Now, those people can be hit hard because what they'll probably do here is change the dividend rate to equalise it with income tax. And the basic rate dividends is about 7.5% or something, very low. They'll whack that up to 20%, you wait and see, which will affect a lot of people who pay themselves through dividends as opposed to salary. So they'll be slipping over to PAY and paying salaries from now on. And arguably, that's probably the right thing to do. So lots of changes coming in. You notice what they're doing is they're not touching income, or any form of income tax. They're going to hit wealth tax. So when you hear them talk about it in the newspaper or on the online press or whatever, they're going to tax wealth. That's what they mean. Now, if you've got a client and you're a mortgage advisor, if you've got a customer, client, or the client's got people, parents or whatever, and they're worried about this, the pure fact is that independent financial advisors can help here. A lot of their advice is tax-based. Tax doesn't wag the investment dog, as they call it, but a lot of your investment decisions can be altered to maximise your tax position. You can move stuff about, is what I'm saying. You can maximise your exemptions, your trusts, that sort of things. IFAs can do a lot of good work with somebody to reduce their wealth taxation, particularly inheritance tax as well. So your action then, if you're a mortgage broker, is to get an IFA in your influencing sphere, in your tribe, and then refer your clients, refer them on. If you've got a client that fits the IFA's client profile, then refer them on to the IFA, and you earn yourself some commission, a referral fee if you wanted to, or it's just giving good advice. Or why not get yourself qualified as an IFA? You can do it yourself then. That's the future for you, by the way. It's more exciting as well. So that's wealth versus income, what you earn versus what you own. I hope that's been useful for you.